Single stock ETFs are flooding the market in 2025, and they promise massive yields of 50%, 100%, or more. But most investors don't realize there's a dangerous income trap hidden inside these investments. I want to share with you what that trap is and how all of you can avoid that before you make the same mistake. The secret is market timing. Hey, I'm Mark Soberman, the founder of NetPicks. I'm really looking forward to sharing with you what I know about these cash flowing single stock ETFs. All right, let's talk about the income trap and what I'm calling the double-edged promise. If you trade certain single stock ETFs, they absolutely have eye-popping yields. For instance, Palantir and MicroStrategy, these stock symbols you can trade as single stock covered call ETFs from PLTY for Palantir and MSTY for MicroStrategy. And we've seen annual yields of 70%, 90%, or even more. They generate regular income that you can withdraw, use to spend on expenses, travel, other investments, or you can choose to reinvest these back into these same cover call ETFs and buy even more on a monthly basis. This is a double-edged promise, right? There's a risk here. These high returns come with heightened volatility. There's a reason they pay out such high distributions because they tend to be very volatile stocks. The other problem is the underlying stock price can erode very quickly during market downturns. There's what's called NAV erosion that definitely takes place that a lot of people don't really prepare for. Now, you can find many of these options at YieldMax. So if you went to yieldmaxetfs.com, you would see these. And you're talking Tesla, Apple, Nvidia, Amazon. You can trade these single stock covered call ETFs. They're all designed to focus on income. And the yields, you can see, are really high. Here's one that's 114%, 63%, 62%, right? This is way above anything you would typically see in a dividend stock. But you got to remember, it's a double-edged sword. Let's take a look at Palantir, for instance. The underlying stock is PLTR. It's been paying about a 90% yield. Wouldn't you like to take out 90% per year? I think we all would. But take a look here at the charts. Now, this is a weekly chart of Palantir. This is using our market timing model that I'll talk about in a moment. This actually went to a buy back in May of 2023. Since then, it has stayed on the buy side. Palantir has been one of the most phenomenal performers in the market. It's about a 10x there in returns since that flash onto the buy side, and it's been on the buy side ever since. If you were to trade the YieldMax ETF, you would expect it should also be going up substantially. Now, this one has not traded as long as that signal. This actually started trading back in October 2024. This is just a weekly chart, but you can see still, even just since October, in not the best market, you're still looking at almost 100% return. Remember, this is paying out, like you saw, roughly 90%. It changes on a monthly basis based upon volatility, but these little distributions are cash flow paid out every single month to reinvest or withdraw. The problem is it's easy to see, wow, I can own PLTY. I can get 90% distributions. This is amazing. But look what happens if you take all of the cash flow out. I'm going to click this down here, and it's going to change pretty dramatically. So this means you took all of the distributions and did not reinvest them. Now, the good news is because Palantir has been so positive during that time, it's doubled. The underlying is still up 22%. And that's with taking, on average, about a 90% yield over 12 months. Pretty phenomenal, right? But what was the secret? The secret was you had to have a stock that was up a lot during that same time. MicroStrategy, MSTR, timed pretty perfectly back in April 2023. This one's been another 10x, right, since that time. I think you would agree if you're trading a cover call ETF on MicroStrategy during this time with all that income spitting out plus upside in the underlying, you should be up a lot. And sure enough, you are. This one started back in February of 2024, so we didn't get that entire year before. But still, with the cover call ETF, this one's almost a 3x. And remember, this one's been paying out 60%, up to 100% or more at times, depending upon how volatile MicroStrategy is. 100% passive. These distributions, these cover call options, you don't have to do any work when you trade the MSTY other than literally buying it in your broker, and any broker would offer these. If you take all of the distribution on a monthly basis, would you agree with one click? The chart looks a lot different. Now, the good news is, just like in the case in Palantir, it's still up about 25% or so. Meaning you can take all of that distribution every single month, spend it on expenses, go travel with it, and your underlying investment would still be up. That's pretty amazing. But you needed to have a stock that was up an awful lot to achieve that if you're going to take all of that cash flow. And clearly that's the allure, right, of these high yield ETFs. Monthly consistent cash flow, 100% passive, incredible yields, focusing on a single stock. That's a win strategy, right, if I ever heard of one. And it is until things go wrong. And that's where the income trap comes in. It is a bit of an illusion because these high yields, it will continue to perform even on a stock that is going down. And it feels like you're doing great because in a way you're being reassured that you're getting this monthly income, even though the stock continues to go lower. You don't know if that stock is ever going to recover. Many good, solid companies will eventually recover. But the reality is you can have some serious underlying erosion, meaning that underlying ETF value is just going down, in particular, if you take all of that cash flow out and you don't even reinvest it. It is essential when these are going down that you reinvest all of those dividends. Otherwise, you're going to be in seriously pretty bad shape on this investment over time. So let me show you on the same charts two other stocks that weren't as glamorous as Palantir and MicroStrategy that for a time had incredible upside, but have rolled over. And that would be Advanced Micro Devices and Moderna. All right, so Advanced Micro Devices here, weekly chart, switched on our timing models in March 2023. Not bad, right? 118%, 133% at the peak. When we finally started to go back to bearish, still pretty good return over time. But that happened in August 2024 when things started to turn a little bit south for this stock. So we flipped to bearish somewhere in this area, this price point. Since that time, this one's been down about 40%. There are some that are down 70, 80, 90%, but this is a 40% decline. Even though it's continued to generate income, when I switch over to the YieldMax ETF, you're going to see it's not enough to sustain itself. So when things were good and we were in that bullish phase, obviously it looked really great on AMDY, this being the YieldMax. But when things rolled over more recently, look at the decline. Even though it is paying monthly distributions, and in fact, AMDY, I think it's in the 60% range, which is incredible. That is not enough to make up for the erosion happening on the underlying. Look, the cover call, I'm not saying didn't do its job to a degree, right? It offset some of the decline. But the problem is, let's say you're somebody said, no, I need to take this income out. I'm doing this for income reasons, and I love 60% yields. I just click this button. This means you took all of the cash flow out. That decline is now almost 50%. You've accelerated the decline, and it's actually worse than holding AMD. Now, yes, in fairness, you were paying yourself roughly 5% of that investment each month, but it was on a declining base because the share price was going down. So now you see what happens on these income traps. Moderna, this one was doing well. Look at this most recent flip. This is down from that point to here, 74%. Now, do you think if you're owning a passive ETF that it should be outperforming in this downside? I think it should be outperforming because it's receiving income every single month from the options. You're not having to do the options. That's the beauty of these, but at least it should be a little better than the buy and hold of Moderna. I'll switch to MRNY, and you can see despite receiving monthly distributions, it's still down. It's not enough to compensate for the underlying stock decline. Now, it is better if you want to consider 64% better than 75% loss, but if you take all that cash flow out, it does get even worse. So if you weren't reinvesting, now it's down almost 82%. So it's even worse than just holding the underlying. You can see the share price down to $2 and change, that rapid erosion. This is why market timing is so key. You cannot stay in on these when they are just accelerating to the downside like this. It just doesn't work. But if you just came in and looked at MRNY and you saw, wow, 63% yield, I don't blame you. You'd want to rush in on that. And unless this V bottoms here and heads back up, and it might. But if you got pulled in by this 3 months ago or 6 months ago, you're still sitting on a large loss despite this really high yield. So I think you can see the real key, the way to avoid the income trap is to look at total return. You got to look at the complete picture, right? That's capital appreciation, your income distributions, all together, right? So you need that underlying stock to at least be going sideways, if not up, and up is better. You want a high yield if you can get it. If it's volatile, you're going to get even more yield. But you got to put both of those together to really determine if this is a worthwhile investment. Don't be pulled in by just that high percentage yield. What's really important is identifying smart entry points, how long to hold it, and knowing when to exit. You're not going to get out at the top. It's impossible unless you're lucky. I've been trading for a long time with NetPicks. I've had this business for almost 30 years. I can tell you getting out of the top comes down to just luck. but getting a little bit off the top, that's when you can put the odds in your favor. So market timing really is critical, and you can do it a variety of ways. There's a lot of technical analysis out there. You can use some of the standards, the RSIs, the stochastics, the moving averages, and they work to a degree, and it certainly can give you a better picture of the market. You can analyze news and fundamentals, earnings reports, all of these things can be done. But what we do is we lean into the market timing models that have worked for us for the last 10 plus years. And I call it our ETF Income Accelerator system. It's really color coded when it comes to market timing. I want this to be a passive approach. I don't want a lot of hard decisions. I don't run the option strategies. I don't write the calls, but I do want them to go up, and I do want to get the cash flow to make up for any erosion to my overall ETF price. Green means buy and stay in. Yellow means caution, and red means I need to be out. So when it turns red, I know with our timing system, I need to get out. It doesn't mean with timing, we're going to get out at the top and get in out of the bottom. No, I don't mind missing out on some of the low, and I don't mind if I don't get in on the peak. If I can get that healthy 2/3, it feels so much better. And also I avoid those huge drawdowns at the same time. Recovery time when the markets go down can take a long time. If you get these 37% hits, it's not going to come back overnight. If I can be out for a good portion of this, I'm not going to avoid all of the loss, but it's going to do a lot for both my psychological state when it comes to trading, as well as my bottom line overall. The thing I want you to really learn from this short video is, yes, covered call ETFs, especially on single stock, there can be a place for them, but they are definitely higher risk, and you absolutely need to manage these more actively. Not every day, not every week, but you have to have some level of market timing, or you will find yourself in trouble with these. I want to invite you to take some action right now. I'm going to put a link on the screen. If you go to that link, you'll go to a very simple page. You just put your email in. There's zero obligations. You'll join our VIP notification list. We're releasing our ETF Income Accelerator system, which includes market timing models, all the covered call ETFs that we trade, how we generate cash flow on a weekly basis, on a monthly basis, but also how we protect ourselves from these income traps as well. Put yourself onto that list. The page will look like this. I will notify you once it becomes available and just give you more information. There's no obligations at all, and you can see if this is the perfect fit for you. I love it. I do it for myself in my personal trading because it's completely passive. It takes me about 5 minutes per week and really protects me during all market conditions. Now, if you have any questions about anything I discussed today, you've looked at other single stock ETFs, you want to get my take on it, go ahead and put that in the comments below. I'm more than happy to answer any and all questions about these income generating ETFs. I hope to be able to share the upcoming video on the ETF Income Accelerator with all of you. Take care, everybody.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.